Good afternoon and welcome to today's presentation, Reading Financial Statements for Lawyers, Part 2. The information presented by the expert is not to be used as legal advice and does not indicate a working relationship with the expert. All materials obtained from this presentation are merely for educational purposes and should not be used in a court of law sans the expert's consent, i.e. a business relationship where she or he is hired for your particular case. In today's webinar, P. Dermot O'Neill will discuss matching principles, cost of goods sold, manufacturing and construction, income statements, cash flow statements, investment financial activities, and balance sheet test cases. To give you a little background about our presenter, Mr. P. Dermot O'Neill is a CPA with more than 40 years of public accounting experience with a BS in economics from Villanova University. P. Dermot's practice concentrates in areas of forensic accounting, litigation, support, business valuation, transaction consulting, financial analysis, and income taxation. He has provided consulting and expert witness assistance in cases involving oppressed shareholders, personal injury, wrongful death, accounting malpractice, contract, and tort issues. P. Dermot is the managing editor of the National Litigation Consultants Review, in which he has written numerous articles. He has testified as an expert in many states, as well as the Federal Bankruptcy Court and Federal District Court. P. Dermot has presented continuing professional education seminars sponsored by various state accounting institutes and societies, bar associations, and universities. Attendees who require a passcode, the word for today is financial. During the Q&A session, we ask that you enter this passcode into the Q&A widget for CLE reporting purposes. The Q&A is located to the left of your screen. Please remember that if you are applying for CLE credit, you must log on to your computer as yourself and stay for the full 60 minutes. You are also required to complete the survey at the end of the program. Please note that CLE credit cannot be given to those watching together on a single computer. Tomorrow morning, we will send out an email with a link to the archived recording of the webinar. The slides can be downloaded from the resource list at the widget at the bottom of the screen. Thank you all for attending today, and Dermot, the presentation is now turned over to you.
Thanks very much, Lauren. I appreciate it. I'd like to take about 30 seconds in the beginning to create a little bit more context based upon the questions that were asked on Tuesday's program regarding the balance sheet. There were several questions relative to using the balance sheet to value a company and so forth. And there's basically three different approaches to valuation. One is the asset approach, which is where you look at the balance sheet, but change the balance sheet values from book values for accounting purposes to fair market value. Another methodology is the income approach, which we'll kind of discuss a little bit today. The income approach basically values the business based upon the earnings of the business or the cash flow from the business, which is the income statement or the statement of cash flow. And finally, we have a marketability approach, which we won't be discussing at all. But the bottom line is that the basic accounting information for valuation, be it the balance sheet approach or an income approach, is really just a starting point. There needs to be analysis and adjustments beforehand. Excuse me. For example, a balance sheet approach typically is not used for operating companies, but is used for holding companies such as real estate rental projects, investment securities, and so forth. So the first term that we run into in income statements is revenue. And the question, of course, is what is it? And basically in the United States, the business term revenue is defined as money or assets convertible into money, that typically is your accounts receivable, that a company receives from its activities during a given time period from sales of product and or services to customers. So basically we're talking about a number that occurs over a period of time. Remember, last time we talked about the balance sheet being a snapshot of the assets and liabilities and equity at a particular point in time. The income statement is over a period of time. So this is the revenue that's generated during a specific period of time, typically annually, but it can be monthly, it can be quarterly, whatever the company decides to do. The second point is that revenue is a United States term. Europe and the UK, for example, and other parts of the world use the term turnover. instead of revenue. So if you see a financial statement with turnover, you know you're dealing with Europe. Also, last time we talked about generally accepted accounting principles. Generally accepted accounting principles are valid for the United States. The rest of the world use what we call IFRS, International Financial Reporting Standards, and they're a little bit different. IFRS basically is principle-based, which we kind of talked about last time in the early days in the United States, and the generally accepted accounting principles, or GAAP, is typically rule-based in the United States. There was a movement a number of years ago to have a convergence of these two different accounting principles, if you will, but that completely failed in the United States. So to give you an example, IFRS has one definition for revenue. The United States has several hundred definitions for revenue, depending upon what you're looking at. Whether you're looking at a construction company, a leasing company, et cetera, et cetera. They have all these rules, whereas IFRS only has one definition. So just be aware that if you're looking at a financial statement from a foreign company, the accounting principles may not be the same. In the Accounting Standards Board, FASB, the concept statement 5 states that revenues should be recognized, and we have a conjunctive test here, when they are realized or realizable and earned. So we have two tests to have revenue. The assets need to be realized or realizable, and the revenue needs to be earned. And by realized or realizable, those are when products or services are exchanged, or assets such as cash or accounts receivable, which would be the claims to assets and so forth. Revenues are earned when the entity has performed all duties necessary for the purchaser. That's what we call the all events test. So revenue is recognized for financial accounting purposes when it's realized or realizable. In other words, we have an accounts receivable, we have some kind of an asset, some kind of a promise to pay, or actual cash that we received, and we, as the service provider or product provider, have done everything that we are supposed to do under our sale agreement. Now, some other variations on this concept. If we receive assets, such as cash typically, before the revenue is earned, a liability is created and not revenue. That liability is typically called unearned revenue, and we've used the example when we were discussing liabilities in the balance sheet on Tuesday of the subscription, where July 1st of 2015, $10,000 is received for a 12-month subscription. At the end of the year, December 31st, the company is still obligated to deliver 6 months' worth as a subscription, so that the earned is only 6 months. Remember the comment we said earlier is that the revenue has to be earned. So we've only delivered 6 months of a subscription, so we only have $5,000 of the $10,000 that we have as revenue. The balance of the $5,000 is the unearned revenue. And the unearned revenue, basically, as we indicated last time, is what we need to do, what we owe to the customer for the future time period. Another concept of revenue is what we call deferred revenue. And this is money, typically money that's received. And in other words, for deferred revenue, we typically actually receive money. We don't necessarily receive a promise to pay. So if we get money, we might be talking about deferred revenue, which is money that the company collects before it actually delivers a product. An example is a software company, let's say SAP or something like that. They might sell a software product and take a payment up front, but the transaction is closed only when the computer program is delivered and gets installed and is properly working. So that upfront payment would typically be a kind of deferred revenue. It doesn't get recorded as revenue because if something goes wrong with the job, the money is at risk. In other words, you may have to give back the money. So it's a liability similar to unearned revenue, but it's a fact that we have some contingencies involved with the performance of the services. Another concept we call accelerated revenue. It's sometimes called bill and hold. And these are revenues recorded prior to the completion of the earnings process, prior to completion of earning the money or earning the accounts receivable. And for this, you can go to jail. One example is U.S. v. Connors, District Court of Eastern District of Pennsylvania in 2007, as an illustration. In the particular Connors case, what happened was, and I'll use just some generalities, is a customer said, okay, I expect to order 10,000 units a month. And they said, okay, fine. So what the company did was all at once they went ahead and manufactured 120,000 units and shipped 10,000 units a month. But then sometime down the line, the customer said, okay, I don't want any more. So that the company was stuck with X tens of thousands of units. What happened is that when the customer first said, I want my first 10,000 units, they actually booked as revenue the entire 120,000 units. And then it went on and on like that. So, and Connor kept hiding this discrepancy, and it basically caused the company to go bankrupt. This happens occasionally in industries that we have what we call conditional sales, which is a sale that's conditioned upon the occurrence of some future event, such as satisfactory product performance, unconditional right to return, those kinds of things. Back in the days before PCs, when we had mini computers and microcomputers and all that kind of thing, a lot of companies were writing software for these mini computers and microcomputers, and they were selling the software, and they had a 90-day return policy or some other policy, which meant that even though the customer paid money or had an accounts receivable to the software company, they could call that back. They could request and get a return of the cash or accounts receivable. So that's a conditional sales contract. So sometimes you see this revenue recorded before it actually is in fact revenue. One of the basic accounting principles that we need to deal with is the matching principle. The matching principle requires that a company match expenses with revenues, at least make every effort to match expenses with revenues in order to report a company's net income during a specific time period. Ideally, it's based upon cause and effect relationship, that sales causes the cost of goods sold and causes selling expenses and causes sales commission. So those are really what we talk about when we're talking about the matching principles. If there's no cause and effect relationship that exists, accountants will show the expenses in what we call period costs. They're in a particular period simply because of the passage of time, not because a product was sold or not because a service was delivered. When a cost is used up or expired, this is the period cost concept. If a cost cannot be linked to a revenues of a particular accounting period, the expense is recorded immediately. So if we pay a bill, for example, let's say an electric bill, and we can't really determine what month it's for or anything like that, we just write it off immediately. So this is basically the matching principle, where at least there's an attempt. And quite frankly, there's unless you're looking at a certified audit or even a reviewed financial statement, you're probably not going to get the accountant to spend a lot of time looking at the matching principle. But nonetheless, it's still an important accounting principle. So that's the revenue. That's the top line. Underneath the revenue, we have cost of goods sold, or COGS, as some people call it. And these are the costs that go into creating the products that a company sells. So the important thing there is that typically you're not going to see cost of goods sold as an expense category in a service organization like a law firm or an accounting firm or something like that. You typically will see cost of goods sold in a retail operation or manufacturing operation, construction, and so forth. So it's a cost that goes into the products that the company sells. And the costs that are included in there are those direct costs that go into production or purchase of the products. For example, an automobile maker would include the materials costs and the parts costs that go into making the car, along with the labor costs used to put the car together. As contrary to that, the cost of sending the car to the dealerships and the cost of the labor used to sell the car at the dealership would not be included as part of the cost of goods sold. Many companies will also include in cost of goods sold an allocation of overhead. The old economics theory of material, labor, and overhead is what goes into the cost of a product. Some companies will also include overhead in there. Overhead can be just about anything. Obviously, one of the obvious overhead items would be the rent for the manufacturing facility where the product is being manufactured. Some companies will charge some accounting cost into overhead for doing the payroll for the plant workers, et cetera, et cetera. This is really an element of cost accounting, which is an entirely different program. And there are various methodologies for developing these costs that go into cost of goods sold. But just be aware that conceptually the cost of goods sold is the cost to the company for manufacturing or purchasing the particular product that's involved. Now, the structure of the cost of goods sold, or the content, the costs that are included in cost of goods sold, will really differ from one type of business to the other. As we say, typically, service organizations won't have cost of goods sold. Some people would argue, well, law firms pay associates, so they're a cost of generating revenue and so forth. So there should be cost of goods sold. That's certainly one argument, but typically cost of goods sold is limited to manufacturing operations and operations that sell products. So the first kind of operation that we have is a retail operation, and cost of goods sold is determined quite simply by looking at the value, the book value of what we had on hand at the beginning of the accounting period, plus the goods that we purchased, and then we subtract the goods that we had on hand at the end of the accounting period to give us our cost of goods sold in a retail operation. So this is the basic formula for a cost of goods sold. It's beginning inventory plus purchases minus ending inventory. Now, within the retail industry, there are different methodologies to arriving at cost that we saw last time in the balance sheet. There's lots of different ways to measure the cost of inventory. And so that being the case, there's also lots of different ways to measure the cost of goods sold, depending upon what industry we're in and the applicable procedures within each of the industries. I won't go into detail in the retail industry, but there's 3 or 4 different ways to determine the cost of the goods that were purchased, for example, and then that would flow into the inventory book value calculations. The next area that we're going to take a look at is typical structure of manufacturing and construction. Well, going back to the balance sheet that we saw Tuesday for a moment, typically in manufacturing and construction, you'll see 2 different kinds of inventory. You'll have work in process inventory and finished goods inventory. And just as the name indicates, work in process inventory is the book value of the work that's going down the assembly line. It's the car that's in process, being manufactured, that's in process. It's the bread that's being baked. It's any number of things that are in the process of being created, going from raw materials into finished goods. Finished goods inventory, of course, is the product that's available to sell, for the public. If it's a bakery, for example, the work in process is the bread that's going from the mixer into the oven, into the into the depanning line, into the wrapping line, into whatever it happens to be. And the finished goods, of course, is the loaf of bread that's on the shelf. And these 2 have their own basic formulaic construction. In the work in process and finished goods, in both cases, we both start with the value of the opening inventory, the inventory at the beginning of the accounting period. With the work in process, we then add the materials, labor, and direct overhead or other costs that were added to the process. This is the flour in the bakery. This is the flour. It's the butter. It's the yeast. All this other kind of stuff. All that goes into making that particular product. And once we get a product finished, we then transfer that product from work in process into finished goods. And the finished goods, then we start with our beginning inventory, plus the cost of product that were transferred in. And in both cases, both the work in process and finished goods, we subtract the ending inventory that's in process, and we subtract the finished goods that are in process. So consequently, and those beginning inventory plus what was put in process or plus what was transferred minus our ending inventory becomes our cost of sales, which is the bottom line. So again, you can see that the structure of cost of sales is simply what we had on hand at the beginning, what we purchased or what we created, minus what we have on hand at the end of the year. So in the financial statement for a manufacturing or construction company, you will have work in process and you will have generally finished goods. In construction, it's not uncommon to have a house, for example, be in work in process inventory for a number of years, particularly if it's a very large house. So you need to not be shocked if you see something in process in year one that's still in process in year two if you're in the construction industry. As we indicated before, service entities generally don't have cost of goods sold, so you won't see that in a service entity. Now, here's an illustrative income statement. Comparative income statement. It's also a condensed income statement. On Tuesday, we had a comparative condensed balance sheet. Now we have a comparative condensed income statement. And it's relatively straightforward. The top line is revenue. The next line is our cost of goods sold. When we subtract our cost of goods sold from the revenue, we've got our gross profit. Then we subtract operating expenses. In this particular illustration, for whatever reason, the financial report was done. The officer's compensation was an item that they wanted to show on a P&L line, income statement line. And then we have depreciation and amortization. Typically, that's shown as a line item on an income statement because we'll see later that it is used to create the statement of cash flow. And finally, we have interest expense, and those are added up to give us our total operating expenses. Again, this is a condensed income statement. Most of the income statements that you see will have a lot more detail, but condensed income statements are certainly fine. And then we have our operating income. Operating income basically is the income from actually operating our business as opposed to something else. Miscellaneous income is something else. It could be interest. It could be sale of excess land. It could be any number of items. And then finally, we get down to our income before tax and comprehensive income. So you can see in this particular case in 05, which is the left-hand column, we have an income of about $5 million. Next, we have a provision for state income taxes. Now, this was an S corporation. I'm sure most of you are familiar with S corporations, where the corporation doesn't pay any federal taxes, but it does pay, in some jurisdictions, it may pay some state taxes. So that's the line item there. Now, Tuesday, we mentioned this concept of comprehensive income, which was the bottom line, if you will. And the comprehensive income is increases or decreases to operating profit for things that have not yet been realized. And the most typical example is investments. So in this particular case, we have investments which are on the books at cost, but the cost is actually significantly higher than the current market value, so that we would need to write that down, decrease the carrying value of those particular investment assets. That's typically why we have this line item called comprehensive income. We subtract the losses, the losses that we have not yet recognized, to arrive at our net income. So generally, this is the structure of an income statement. Now, if you have an audit or if you have a review, more likely than not, you will have this concept of comprehensive income on the income statement. If you have a compilation, or as we talked about earlier, the new product, a financial statement product produced by accountants, or an internally produced financial statements through QuickBooks or something like that, you probably aren't going to have it. But if you do see it, excuse me, that's what it's all about. Okay, I think this is the time for questions, Lauren. If we can take those.
Thank you. We are now entering the Q&A session. Please enter the passcode in the Q&A widget during this time. The passcode is financial. Please remember that if you are applying for COE credit, you must attend for the full 60 minutes of the presentation. Also, please enter any questions that you have in the Q&A. First question we have is, what are the generally accepted methods of determining the proper adjustment to accounts receivable for a service business, specifically a medical practice?
Oh, okay. Medical practices are real interesting. Again, we will accept tax. We'll talk about accounting. It depends on the methodology that's used by the particular medical practice. In medical practices, there's a couple of different, there's two primary methods that they use. One is when they record as accounts receivable the total billed amount of the particular service. And then when the insurance company pays whatever the contracted amount was, they'll reduce their accounts receivable by that number and then write off any balance of accounts receivable, typically to an account which is what we call a contra revenue account. The other methodology that's used is when they show in accounts receivable only the contracted amount for the particular service. If that amount is not paid by the insurance company or the patient in some cases, then that's written off as a bad debt. So it's pretty much dependent upon which methodology you're actually using to record revenue within the medical practice. And again, it differs with physician practices, ambulatory surgical centers, specialist practices. They all have generally one of the two, principally, they have one of the two methodologies, and those are generally what you'll run into.
Next question. How are barter transactions dealt with on financial statements? For example, a painter paints a home of an accountant in exchange for not being charged for accounting work.
How are they handled, or how are they supposed to be handled? Barter income is subject to income taxation. So theoretically, the credible accountant is recording the barter transaction. And simply, the way it would work is that the painter, let's use a painter for example, he's giving $1,000 of painting services to the accountant for $1,000 of accounting services work. Well, the painter is already, part of his cost of goods sold, if you will, or part of his operating costs are the paint that's being used, so he's getting a deduction for that. The only thing it's not showing is the differential between what the theoretical billing amount is and the paint. What's supposed to happen is that the painter is supposed to record the $1,000 revenue, which is the barter value, and record a $1,000 accounting expense. And of course, the accountant is supposed to record $1,000 accounting income. And if it's his home as opposed to his office, he's going to show that as some kind of a distribution of profits. So that's the way it's supposed to happen. I am not going to tell you that it always happens that way. I think we'd all be naive to think it does, but that's the way it's supposed to happen.
Can a company switch back and forth to different methods of accounting?
A company is allowed to change accounting methods, but switching back and forth is not really permissible. I will tell you, the Internal Revenue Service, for example, when you elect to change accounting methods, the Internal Revenue Service has a 5-year window where you can't change accounting methods anymore. So once you make a change in accounting method, you've got to keep it for 5 years. There's a concept in accounting that is verboten as far as switching back and forth, because you're supposed to look at using an accounting method which reasonably determines the operations of the company. And of course, you choose a method, it doesn't make sense to go back and forth from an accounting standpoint to keep changing. Okay?
How can you tell from the income statement what method of revenue recognition is being used?
Quite simply, you can't. You need to have somebody to tell you, accountant or somebody else to tell you how the revenue is being recognized. For example, as we talked about on Tuesday, we have long-term contracts, and there are several different accounting methods to account for revenue and assets and liabilities under long-term contract accounting. So you actually need somebody to tell you what the method is. You can't just simply look at an income statement and determine what the method is.
Why don't service organizations have cost of goods sold, like labor, for instance?
That's basically not accounting principles. Accounting principles basically look at, it says cost of goods sold, and the accounting principles say you've got to be selling a good as opposed to a service in order to have cost of goods sold. It's a rather simple definition, but a lot of businesses will, the CPA firms, for example, know what their cost of labor is in generating CPA services, and of course law firms know what their cost of labor is in generating legal services, but they're not shown that way on financial statements.
How does the matching principle work when there is a time period difference between receiving the revenue and paying the related costs?
As we indicated, there should be an effort to match revenues and expenses, but if you can't match revenues and expenses, then the expenses can't or are unable to reasonably do it. I mean, there are costs in these kinds of things. If you're unable to reasonably do it, you just simply take the expense whenever it's paid in the current period.
Okay, thank you for answering those questions. You can move on with your presentation.
Thank you. Now, you recall on Tuesday we talked about the basic accounting equation: assets equal liabilities plus equity. This is the entree into the cash flow statement. Now, one note of caution. We're talking about a cash flow statement here. If you have a certified audit or if you have a review, you will definitely have a cash flow statement. If you have a compilation, you may or may not have a cash flow statement. If you have internally prepared financial statements, you may or may not have a cash flow statement. If you're relying on tax returns, which is common, and probably in my cases 40 to 50% of the financial statements are really the tax returns. If you're relying on the tax returns, you're not going to have a cash flow statement. And we'll see a little bit later how the cash flow statement actually acts as a double check on the credibility of the balance sheet and the income statement. It all goes back to our basic accounting equation of assets equal liabilities plus equity. Now, in the cash flows, as we talked earlier, The typical categories we have under assets are cash, accounts receivable, property and equipment, other assets. Under liabilities, we have things such as accounts payable, notes payable, accrued expenses, which we talked about on Tuesday. We have in our equity sections, but the definition of equity was basically owner's investments minus owner's distributions plus revenue minus expenses. And the revenue minus expenses is typically what we call net income, and net income is what we just saw a couple of minutes ago. So this is the basic structure of our financial statement and our basic accounting equation. Now, what's the statement of cash flow? The statement of cash flow attempts to measure the cause of changes in cash. You can see we have that cash with the delta symbol. The cash flow statement basically measures the changes in cash. What caused the changes in cash? So you go back to the basic accounting equation. We have one item that's changing. Then that item that's changing, that's changed must be the result of everything else changing. So that's basically the structure of the cash flow statement. The cash flow statement is the sum, the changes in cash actually is the sum of all the changes in all the other accounts in assets, liabilities, and equity. So that's the concept behind the cash flow statement. To determine, we know what the change in cash was. It's the difference between the beginning and ending balance. So we want to know why, what caused that change in the beginning and ending balance in our cash. It's very helpful information. I personally feel this is the most valuable of all the financial statements. So the cash flow statement is one of the basic financial statements that shows a company's incoming and outgoing cash during a specific time period. Again, cash flow statement covers a time period as opposed to a balance sheet, which covers at a specific date. The statement shows how changes in balance sheet and income accounts affect the cash and cash equivalents. When we're talking about accounting and we're talking about cash, we're talking about cash equivalents. Cash equivalents might be liquid investments, could be bonds or something like that. So this is what we're talking about, cash and cash equivalents. And it breaks down the analysis into operating, investing, and financial activities. So that the change in cash, we break down the change in cash between operating activities, change in cash, investing activities, change in cash, and financial activities, change in cash. So it's an analytical tool for use that's useful in determining the short-term viability of a company, particularly its ability to pay bills. And we'll see a little bit later, that's one of the elements of determining insolvency. So the cash flow statement is very, very helpful in determining a company's ability to pay bills, particularly not so much at a point in time, but when we look at 3, 4, 5, or 6 years comparative cash flow statements. It's very, very helpful. Now, the 3 activities. What are operating activities? Operating activities include the production, sales, and delivery of the company's product, as well as collecting payment from its customers. Operating activities essentially start with net income, because that's what we talked about earlier, net income. And what causes that, what uses cash in an operating cycle is the purchase of materials, purchase of inventory, advertising, shipping, generally measured as net income. So that net income that we talked about is basically the starting point for our determination of cash that was generated by operating activities. The next item we talk about is investing activities. Well, what's an investing activity? An example of an investing activity is the purchase of long-term assets that a company needs in order to make or sell its products, and the selling of any long-term assets that are no longer needed in the company. Now remember, purchase of assets is not an expense. It's the creation of an asset. It's property, plant, and equipment that we talked about on Tuesday. Okay? And that's charged, as most people know, with depreciation and so forth. Every once in a while, some of the equipment that we have will be sold. and so that becomes a source of cash from an investing activity, the selling of these long-term assets. Now, this could also relate to if the company is invested in securities, the purchase of securities and the sale of securities. These are all investing activities as opposed to operating activities. Remember, the concept of operating activities are activities that are the reason we're in business, as opposed to investing activities, which are, shall we say, ancillary activities. And finally, we have financing activities. Financing activities include influx of cash from investors, such as banks and shareholders. And within the accounting concept and the economic and finance concept, banks are usually included in that buzzword, investors, which is a whole different subject, so we won't go there. But financing activities include the influx of cash from investors and such as banks and shareholders. Also includes the outflow of cash to investors, such as dividends and so forth, as the company generates income, plus the repayment of debt. So that different kinds of borrowing activity, long-term liabilities, short-term liabilities, equity investment by owners, etc., are all covered under this financing activities concept. The financing activity concept is basically where do you get the cash, where do you get the money to run your business in addition to operating activities. Now, this is a sample cash flow statement. I would just, one aside here is that there is actually two different approaches to doing a cash flow statement from an accounting standpoint. What we have illustrated here is the indirect method, which is the most commonly used methodology. The other is called the direct method. And the direct method basically is real simple. It starts with how much cash we got from customers, how much money we spent for expenses, how much money we borrowed from banks, how much money we paid back to banks, etc. It's a very, very simple methodology. However, accounting systems aren't really geared to allow an accountant to perform the direct method. For example, we look at all the money that's been deposited into a company's bank account. You know, how do you separate what came in from customers, what was borrowings, what was repayment of expenses by employees, whatever. It's very difficult in the United States methodology of accounting to keep track of all that stuff. So we use this, what we call the indirect method. And you can see the indirect method starts with our income from operations, as we said, is our starting point. Now, we have some expenses which really don't cost us cash from an operating standpoint. And those expenses are something like depreciation, for example. So we add back the depreciation that we deducted, and we add back amortization. We said on our income statement we might have recognized gain or loss in the sale of equipment. Well, the gain or loss didn't give us cash. The amount of proceeds gave us cash, but not the gain or loss. So we add back the gain or loss, or adjusted for the gain or loss. Obviously, losses are a problem. The next one they talk about is accounts receivable, which is a reduction. In accounts receivable, if our accounts receivable goes up as a result of our business activity, that's really a use of cash because our top line, our net income, has those accounts receivable sales in there. So we have to adjust that out to determine how much cash was generated. And the same thing with accounts receivable, current assets, other current assets, et cetera, et cetera. But the bottom line of it is that the bottom line of the top section tells how much cash or what cash was generated by operations of our business. So this gives you an idea from a cash standpoint of how effective the company was in generating cash just as a result of operations. You'll see in the first year, in '04, all the way over on the right-hand side, we have a negative $1.2 million. Well, that means that the company's operations actually cost them $1.2 million in cash in that year. But then in the following year, which is '05, that kind of got recovered, where the operations generated $1.2 million in cash. As I said, this gives you a good idea when you look at this over a longer period of time, how effective the company is in generating cash from operations. The next two sections that we talk about is the operating and investment. It's not the operating, excuse me, the investing and the financing activities. And you can see in this particular case, in both years, the company invested in assets, or in this particular case, they dispose of assets, so we have a net number in there. A lot of times, if you can, and again, the system may not allow you to do it, show how much the investment activities was from purchasing assets and what were the proceeds from selling assets was. But in this particular case, it just shows a net number, which is a net use of cash, which basically it's a reduction in cash, so it's utilization of cash, net utilization of cash for acquisition of equipment or property. And then finally, the financing activities, and you can see down the bottom the negative numbers. Those are distributions to the shareholders, which is determined to be a financing activity. Down here we show the beginning balance in cash plus the cash that was provided by these three functions to come up with the ending cash balance. So the bottom line is always going to be the ending cash balance, this financial statement. But it gives you a real good pulse as to how much cash is being generated by the business, how much cash is being generated by debt, and how much cash is being distributed to the shareholders, or how much the shareholders' investment happens to be. Now, we had talked during the concept about bankruptcy and insolvency. We talked some pieces Tuesday, about valuation, and one of the aspects of valuation where we may get involved with it is insolvency, and I just thought this was an appropriate time to look at insolvency, because many people look at the financial statements to give it a quick look to see if the company's insolvent. So as we know, there's three tests for insolvency. The Bankruptcy Code 11 U.S.C. Section 101 is what we generally call the balance sheet test. There's other more formal tests called the ability to pay debts test, which comes out as part of what we'll call judicial interpretations in courts, and also the adequacy of capital test. And we're not going to go into a great amount of detail, but we're going to show you how the financial statements work or may not work within those environments. Excuse me. My friends in the investment banking industry say that insolvency is basically a binary decision. You're either bankrupt, you're either insolvent, or you're not insolvent. It's not you can't be a little bit insolvent or a little bit not insolvent. You're going to be either insolvent or not insolvent based upon these tests, and it's not uncommon, particularly in litigation environment, in bankruptcy, we're looking at clawbacks and preferences and all that kind of stuff, to do a couple of different tests and perhaps come up with a couple of different conclusions. So we'll let it go at that. Now, the Bankruptcy Code test, insolvent means with reference to the financial conditions such that the sum of the entity's debts, which is L in our formula, is greater than all such entities' property, which is A in our formula, at a fair valuation, exclusive of property concealed, et cetera, et cetera. So that becomes the U.S. Code definition of insolvency, where the fair valuation of the liabilities is in excess of the fair valuation of our asset. Now, people say, well, just look at the balance sheet. The balance sheet we saw Tuesday. If equity is negative, they're insolvent. If equity is positive, they're not insolvent. Well, it's not quite that simple. I use the analogy, and I forget what I used it here. I used it at trial last week, where looking at a balance sheet to determine insolvency is like looking at a cookbook, a picture of a bowl of soup, and somebody asks you, how does the soup taste? Well, you can't taste the soup unless you make it. It's just like insolvency is the same way. You can't just look at a balance sheet and see whether something is insolvent without doing the analysis. Now, for example, in real estate operations, it's quite common to have negative equity because the building that's maybe purchased for a couple of $1 million, you're depreciating it over time, and it may have a relatively low value on the balance sheet and thus create negative equity. But in fact, the fair valuation of that building may be many millions of dollars. And so when you make the fair valuation adjustment to that building, you're going to come up with a positive equity number at a fair valuation, and consequently will not be insolvent. So as we said in the last paragraph here, the definition on 11 USC is the the balance sheet test, because it requires a comparison of the debtor's assets to liabilities. Notably, the Bankruptcy Code never defines what qualifies as fair value or fair valuation, and leaving that to the courts to determine on a case-by-case basis. So this is the concept. This is where a lot of people will, not a lot of people, but people will use the balance sheet and attempt to draw a conclusion about the solvency or insolvency of a company just looking at the balance sheet. You can't do it just by looking at the balance sheet. There has to be analytics done. The ability to pay test is quite simple. Can the debtor timely pay its obligations? This is known as the cash flow test. In using the cash flow test, it's the statement of changes in cash flow statement, if you will, is very, very helpful. If you see a continuing situation over a number of years where operations are consuming cash, they've got negative numbers in cash provided by operations, and you see the debt continuing to increase, you start to get a sense that as to whether or not the company has the ability to pay its obligations timely, or whether it's funding its current obligations with other borrowings. I don't want to be a wise guy here, but it almost smells like a Ponzi scheme, where the current obligations that are due are being paid by new obligations. So the cash flow statement is helpful in taking a look at that. And the adequacy of capital test. This, I have to thank one of my investment banking friends for this. Conceptually, it's easy to understand. The debtor fails this test if it has an unreasonably small amount of assets in relationship to its liabilities. But one has to be careful when a term like unreasonably small, it's a fuzzy term, which is a quote from a Boyer v. Crown decision. As a practical matter, the application of this test might be somewhat similar to Justice Potter Stewart's definition of pornography. I know it when I see it. So the adequacy of capital test is kind of like a smell test. There's no real definition of it, but it's something that needs to be considered when you're considering insolvency. Now, one of the really important things relative to the cash flow, I said earlier that if you have a tax return, you don't have a statement of cash flow. In the case that I had last week, I had about 13 or 14 years of tax returns from 2010 through 2015. 2013, 14, and 15 was prepared by a different CPA firm that prepared the first from 2010 up to 2012. And obviously, I said there's a tax return. There was no statement of cash flow. I did my analysis all that time period and found that in 2013, 14, and 15, the cash flow statement showed that there were errors. Just told me that there were errors. Didn't say where the errors were or anything like that. And it can be significant. In 2015, the error was about $90-some thousand. In 2013, the error was about $500,000, but in 2014, the error was $18 million. I had an idea of what caused it. There was one transaction for $15 million that the accountants reported, but in fact, there was two checks written for $15 million each. So I suspect that of that $18 million error, $15 million of it is one check. However, when you're testifying, that could be you could be accused of speculation, and since the books were terrible, et cetera, but the importance of that statement of cash flow is it acts as a double check against your balance sheet and your income statement, and that's why it's so valuable. Here's an example of a case that I was involved with in bankruptcy court in New Jersey. Plaintiff was attempting to recover avoidable transfers. The transfer, this was an S corporation. What happened? The corporation paid the individual shareholders funds to pay their income taxes on the previous year's profits. The expert calculated that the defendant was insolvent using all three approaches. Defense expert issued a review report indicating errors such as not using available appraisals to determine the fair value of the assets. Assumed debts of an affiliate would become the obligation of the defendant, etc. And all of these and several other factors were indicative that the defendant was insolvent. After the deposition of the defendant's expert, plaintiff offered a settlement proposal. Defendant declined, and subsequently the plaintiff dropped the case. So these are illustrations of how financial statements and all that are used in a litigation environment. And I think, Lauren, we're coming up to the question and answer session.
Yes, we are entering the Q&A session. Please enter the passcode in the Q&A during this time. The passcode is financial. Please remember that if you are applying for CLE credit, you must attend for the full 60 minutes of the presentation. You are also required to complete the survey at the end of the program. Also, please enter any questions that you have in the Q&A. The first question we have is, Sears put in its recent statement that it had issues with continuing as a going concern. What does that actually mean?
Oh, okay. A going concern opinion means that there's some possibility that the company may not exist beyond the end of the next accounting cycle, which is 12 months. It's really kind of like a flashing yellow light. The requirements, not requirements, actually I've had some litigation on this issue. What the AICPA says and the audit standards say relative to going concern is that if the auditor sees some situations where there's a likelihood within the 12 months that within 12 months of the next operating cycle that the business may have difficulty getting financing to continue as a business, they need to make that expression vis-a-vis a going concern opinion. I had one bankruptcy case a number of years ago where the auditor did not issue a going concern opinion, but their work papers indicated that they saw 14 months out that the company would have a problem financing their debt and potentially a $50 million cash shortfall. They did not issue a going concern opinion because their argument was that it was within within the 12-month period they didn't see a problem. They saw a problem 14 months out. Well, clearly, that defeats the concept or the principles of going concern. This gets back to what we were talking about on Tuesday, the difference between principles and rule. The rule says if you see it within 12 months, you've got to issue a going concern opinion, but it doesn't tell you what to do after beyond the 12 months. I hope that answers the question. It's an interesting question.
This is our last question. What's the difference between dividends and distributions?
The entity. C corporations, C corporations, which are what we call regular corporations, pay dividends. They don't pay distributions. S corporations that were previously C corporations can pay either dividends, which are earnings that were accumulated during the C corporation period, or they can pay distributions, which are payments to shareholders as a result of S corporation earnings. So any corporation that has a previous history of being a C corporation may have what we call accumulated earnings and profits out of which dividends are paid, or they may have S corporation earnings which can be paid out in the form of distribution. So a company that was previously it's an S corporation now was previously C corporation may actually have both, and that can be an election by the shareholders at the corporate level to either pay dividends out of the previous earnings and profits or pay distributions out of the S corporation earnings and profits. Finally, if you've always been an S corporation, you'll get a distribution as opposed to a dividend. Hopefully that clarifies the terms.
Thank you for answering those questions, Dermot.
You're welcome.
In addition to being your best source for testifying and consulting experts for the past 60 years, TASA also offers e-discovery and forensic solutions, free interactive webinars, and day-in-the-life videos. Also, research reports on expert witnesses, such as Challenge History Report 2.0, Professional Sanction Search, Expert Profile 360. I want to take this opportunity to thank everyone for attending, and most especially P. Dermot O'Neill for his time and effort in creating this presentation. If you would like to speak with Dermot, or if you would like to speak with a TASA representative regarding an expert witness for a case that you are working on, please contact TASA 1-800-523-2319. One of my colleagues will be following up with you regarding your feedback on today's presentation. This concludes our program for today.